you address or expand on the difference between the growth in revenue and the basically flat EBITDA that you're showing? What's accounting for that if CapEx is growing at historical rates?
Are you referencing the EBITDA margins or the growing EBITDA?
The graph, your revenue and profitability growth graph?
Right. So those are growing revenues, and we're forecasting the margins to stay constant over time. What is that in relation to the CapEx? What was the question?
What's accounting for the fact that revenue's growing and earnings are not? Or not at the same pace?
It's the margin. So the EBITDA as a percentage of the revenue is growing, but however, it's just the margins, this percentage of revenue is going to be higher, if that makes sense.
And you can also see that margins are actually slightly increasing through our forecast period. And this is due to the increase in crude oil production, which helps the processing, recovery, and disposal division by having more throughput in each of their facilities. So their fixed costs are kind of dispersed over more revenue from increased throughput as the crude oil production increases.
Here in Colorado, we have a nickname called Mile High, and you may know we've recently passed a couple of laws that actually may play on our name. One of those laws, though, is related to fracking, and the regulatory environment in this state is very much against. There's a tremendous faction that's against fracking itself as an industry and an industry pursuit. In Alberta, where there's a predominant amount of the income that's being generated from this company, what is the regulatory environment with regard to fracking and not in my backyard?
Yeah, so that really isn't an issue much in Canada and Western Canada. So of course, that's true. Because of course governments derive their revenue off of royalties. Royalties come from the oil and gas companies. So the more money that the oil and gas companies have, the more revenue the government has. So hey, everyone wins. But you're right, there is a regulatory problem. And so actually Secure is really good because environmentalists actually like the company because they do remediation of wells. So they make sure that after the oil and gas producers have dug up the land, that they're going to remediate the land and make it all nice grass green. You can have a playground for your kids and stuff like that. So I mean, it's not really much of an issue. And as per Nathan actually mentioned regulatory risk, and so much of the regulatory risk actually works in Secure's favor because tighter regulations, example, tighter regulations on oil specifications. Secure cleans that oil to make sure that it's up to spec, so that makes sure that the oil is a lot purer, and also when you're putting it in a tank car, it needs to be cleaner, because if it's not, then you start to get the explosions like Lac-Mégantic because there's too much sulfuric content in it. So likewise, I think more regulatory enactment, they'll do well. Less, they'll still do the same. Thank you.
Explain the lawsuit risk a little bit more and why I would want to own a stock with lawsuit risk and only 6% upside.
Sure, I can address that one. So back in 2007, there was a PRD, or Processing, Recovery and Disposal company called Tervita. Now, a handful of key employees actually left Tervita and created Secure. Now, the current CEO, Mr. Amaro, actually participated in a in a laptop buyback program. Now, Tervita believes that there was proprietary business information on that laptop that they misused to grow Secure. However, Secure actually made a counterclaim to unlawful defamation of their reputation. So Tervita is looking for $110 million in damages, as well as disgorgement of all profits since inception. The reason we didn't include this in our valuation is for two reasons. One, Secure has not actually provisioned for this contingent liability. And in addition to that, for Tervita to be actually successful in claiming all the disgorgement of their profits since inception, they would have to prove that through Secure's inorganic growth, strategic acquisitions, as well as all their organic growth, and the company that they've made it today, is a direct result of Mr. Amaro participating in a laptop buyback program that he had full rights to the laptop. So we just don't believe that this is going to materialize over our forecast horizon.
Follow-up, did you seek legal advice, or did the company share specifics with you?
I don't claim to be a lawyer, and I don't know any good ones. But No, we did not directly contact any legal professionals on this matter. However, we did look at some of the proceedings that have happened up to this point in the case. Tervita tried to claim and set up a collective trust over all of the assets of Secure and one of Secure's joint venture partners. However, this was ultimately unsuccessful in the courts, and Secure was awarded costs for that lawsuit. So, and it was made on a similar argument to the one that Tervita is making now. So, for that reason, we don't see it as a material risk to an investment.
Okay, so could you please elaborate on how you get to the 8.1% of the weighted average cost of capital? Because as I see, there's more equity than debt, so I don't get how you get to the 8.1%.
Sure. So I'll start with the cost of debt. Secure has all their debt in a revolving credit facility. So they pay on this credit facility the Canadian prime rate plus a credit facility spread plus a standby fee. So we took all these numbers so we took the average of the credit facility spread, and actually as you can see at the bottom of the slide, you can see the credit facility requirement for debt to EBITDA, which they have been well below at all times. And also management has set its own requirement for debt to EBITDA, which they haven't touched yet. So in terms of riskiness, that's why we took the average of the credit facility spread there, because they're going to pay a lower rate. And that then we arrive at an after-tax cost of debt of 2.82.
And I'll break it down through the components of cost of equity. So for our risk-free rate, we use the 5-year government bond rate, and so that matches the cash flows for our forecasting period. And then for our terminal year, we use the 30-year government bond rate. For our beta, what we found is we took a 2-year levered beta against the TSX Composite, the main index in Canada. And then for our equity risk premium, what we did is we have a bottom-up model of all proposed dividends and share buybacks over the next 5 years. And what you can do is if you discount those at a specific rate and you find the S&P 500 value, you can find the IRR, which is the expected return that investors are expecting. And so we use that for the next 5 years as our equity risk premium to give us a cost of equity at approximately 8.5% average, and then jumps up to 10.7% for the terminal year.
And just to follow up regarding the cost of equity, don't you think that the risk relation you should have considered the 20-year, given not the expected cash flow, because you made a forecast for 5 years, but the investment on the company is gonna last a couple of more years?
So we also use the historical 50-year equity risk premium for our terminal year, and then we use that for the terminal year. So it accounts for the perpetuity of life of all the equities in the S&P as well as Secure.
Okay.
A follow-up on the cost of equity, cost of capital, the WACC and so forth. Did you state earlier that at some point, perhaps next year, there's going to be a new equity round and a new debt round? To what degree have you incorporated any of those potential dilutions or impacts on the cost of debt or the cost of equity?
So that comes into, Rehan mentioned in the presentation, we have an average WACC. So WACC changes every year based on how we assume, because we are assuming that they're issuing debt and equity in 2014 to fund some of their capital expenditures and the acquisition. So this goes directly into our valuation, and our capital structure is changing with each year in our forecast period.
We haven't talked a lot about their competition. Their competition's not sitting still and looks to me to be significantly stronger from a financial basis. Talk about the competition and why you're not worried about that.
So Secure does not have very much direct competition, because Secure is very unique in the way that it's integrated into the life of the well cycle. So the closest one is Tervita, which Secure has been carved out of. Tervita lacks the drilling services division, which is a very key part of the business model, because the Secure starts with the on-site division, and they come on before when a customer says, we want to drill a well. They bring out the on-site division.